Financial Survival Network, helping you survive and thrive in the new economy. Go to CarrieLutz.com and sign up for 30 free micro trainings on financial survival.
Great news, we've got a sponsor. This show is now brought to you by Miles Franklin. And when it comes to protecting your wealth, you know there's nothing better than gold and silver. That's what I'm buying. I hope you're doing the same. And once you make the decision to buy gold and silver, there's no better place than Miles Franklin. Look, they've been in business 22 years. And the reason I'm a customer is because when you buy, they ship. Go to milesfranklin.com or call them at 800-822-8080 to get a free quote. 1490 WGCH. This is Carrie Lutz, and you're listening to the Financial Survival Network. Gold, silver, weirdest markets. No one quite gets what's going on, but I've got Gary Wagner on the line. We're going to check the charts. The charts tell the story, and the charts will let you know when it's safe to go in the water again. Gary, hey, welcome. It's really good to be back with you.
Absolutely. Good morning to you, Gary. How are you today?
It's great. We had thunderstorms on the East Coast, and now it is a gorgeous day, and we're getting back to spring again.
There you go.
So these markets, interesting times, huh?
Absolutely. Absolutely. Just when you think it's safe to enter the water again, the markets take a turn that is unexpected. But the interesting thing is that I still absolutely believe that we are in a super bull market, a super bull cycle. I believe that we're towards the tail end of that cycle, in that on a 13-year cycle, we probably have a year and a half as we go to new record highs and approach 2000. But in the interim, when you look at the what I call the intraday noise, it's perplexing to say the least.
And what's really perplexing about it? Because we're looking at this chart, I'm seeing like it's a senseless market. It's just afloat.
Well, it's senseless if you don't have the proper tools, I believe, to make sense of it. Now, I am a staunch technician, and the reason for being so focused on the technicals is mathematics is such a pure language. And I guess the easiest way to say it is if you listen to one economist and listen to their compelling reasons why they believe gold is going up, at the end of it, it makes logical and rational sense, and you think, okay, the market's going up. You change the channel to the next financial news network, and you have another renowned economist giving you his logical and fundamental reasons why gold is going down. At the end of it, you become a spinning top. In other words, as an analyst, I'm guilty of this also, but we have a diverse set of opinions. Mathematics is a true language. Math doesn't lie. And so the chart that we're looking at is what's called a Henkin Ashi. It just means a Japanese average chart. And what you can see when I blow that up is you'll see a series of red and then green candles. And if you notice, as this market comes down, you just get a series of straight red candles. At the turning points, at these key pivotal points, these key reversals, the candles get very, very small, and then they move and change color. So it's a very, very visual way to look at the market. Also, what you'll notice is that I am putting on an Elliott wave count. And if you have a proper Elliott wave count, it really gives you a solid handle as to where we are in the big picture. Because what R.N. Elliott did is he was able to recognize that there's truly patterns within markets as they move. And if you can quantify them, then you have the ability to really know where you stand within a market and where that market stands within its own time frame.
All right. So briefly, what's this chart, which I see what you're talking about. The red, man, is really violent, and the green is kind of mildly goes up and only to get taken down by the red again. So that's really shows me behavior more in keeping with a bull market where the pullbacks are very violent and vicious and throw out, I guess, the weaker holders, and then it just floats back up to its level. Am I reading that right?
You are, and one of the things that we really can do, and let me see if I can shrink this down just a little bit so we get a better idea. This is our record top here, which is marked as 3 and then 5. In Elliott wave theory, his theory is that in a bull market, it's going to move in a series of 8 total waves. I'll try to draw them for you. 1, 2, 3, 4, and 5. These are called the impulse waves. And following that, you're going to get what's called an A, B, C correction. Now, here's what's interesting, Kerry. Typically on these types of corrections, especially what's called a wave 2, you will normally get what's called a 61% retracement. And that's to say, if a market goes from $1 to $2 and then corrects, it's going to correct down approximately 61 cents out of that dollar move or give it back. Now, with that in mind, if we look at this recent move that we had in gold, and I'm going to go ahead and blow it up. And what I mean by the recent move is the beginning of this rally, call it 1227, takes us from about 1520 to about 18 or 1790, right around there. If you can see this top and this bottom. Now, when you put these in and you look at what's called a 61% retracement, meaning it gives back that amount. Let me highlight it. This is 61% right in here.
Oh,
and as you can
like
see,
right there,
as this market came down, it basically touched that point and then moved back up. And so when we actually make a recommendation, for example, we bought gold at 1640 and 1658. We got in a little bit early here. I thought it had concluded. It came back down and we dollar cost average. So we have an average price of 1650. Now, even with this tremendous move down, we still have a couple of dollars of profit in the trade. And I believe that because we have another 61% retracement, that we've seen the bottom of this most recent correction today. Here, if we look at this move right here, this is this most recent rally.
Right. I see what you're saying. Yeah.
Okay, and then you look at this right in here, you get exactly a 61% retracement.
Right.
I mean, precisely, it goes right to 61% from this move up. The way that I try to teach my subscribers about Elliott Wave is, do you remember as a child seeing the Russian dolls where it's a small doll and another doll, and they're all identical, but they're all one level bigger? In the same way, Elliott Wave counts have minor, intermediate, major counts, meaning they are Russian dolls. They are waves within waves within waves. So this 4 is what's called a major wave, and it came after what's called an ABC correction, what we just talked about. And then we went into our impulse phase, and our impulse went 1, 2, 3, 4, and then 5. You see that, Kerry?
Yep, I see it right there. It's clear.
Now, for our correction, we believed it was going to go to 61%, but typically it will be A, B, C. In this case, it was a 5 count, so it went A, B, C, D, and then E was your bottom.
Right. See it.
Now we start all over again. So the beauty of that is we're now back into where we've started a new impulse wave, impulse 3 of 5. And that's how I'm actually doing this forward forecasting, believing that the market will go again to 1900 plus, is that we have this impulse wave, which is 3. It'll be followed by a corrective wave 4, and then a final impulse wave 5. But on this one, what we have noticed, and this is what kind of caught me off guard, I didn't think it would happen so quickly, but we've already gotten our 1, and now we've gotten our 2, which means we'll get a 3. Now, here's the beauty of this forecasting tool. One of the rules in Elliott Wave is wave number 3 cannot be the smallest of any of the impulse waves. What that means is that we will see a rally right now that's at least equal to what we saw in wave one. So on a very simple way is I'm just going to use a scalable line to see the distance of wave one. And now I can tell you that this wave three should take us to about 1720. So we should see a rally right now of about $60.
Uh-huh. And this is just human behavior. The waves are just reflecting human behavior, right?
Absolutely. Everything within nature follows physical laws, and the psychology of trading falls within those guidelines also. And this is what's called the psychological aspects of mass psychology in market behavior.
Right. So it's going to hit up to that roughly 1720 range. Then it's going to do a retracement again. Are we looking at an ABC?
Well, if you have one, this is our wave one. We just started it. Should take us to, we had one here, two. This is going to be three. So we'll get a retracement for four, and then a final push up to conclude this cycle, and then go into our ABC. In other words, it's always going to be the first five waves are 1, 3, and 5 are your impulse waves, 2 and 4 are your corrective, and then you go into an ABC cycle.
So we're looking in that 1760 range, and then repeat the process.
Right. Then go into a correction and then repeat the process. Exactly.
Uh-huh. And do you think the wave is showing any manipulation or intervention here by the central banks?
You know, that's what's really interesting, because for wave theory to be accurate, it's got to take into account all of those variables. And there's been a lot of interesting things going on in the market, especially right now. We had options expiration. I read articles about how the COMEX is artificially keeping a cap on gold below 1,700. I find it hard to believe that anyone has the ability really to manipulate a market to that degree, but there is no doubt there is something going on there. And we know that the central banks since 2009, up until then, were net sellers of gold. Now they're net buyers of gold. So that has to tell you something.
Yeah, I have a theory about the central bankers, too. Even the ones that haven't announced that they're buying, I think even the Fed, the ECB, they're all buying on the sly and trying to make it look like they're not. Now, how they're buying it, I don't know where it's coming from. But if you're a central banker and you see what's happening and you realize that you're losing control of the money supply and the ability to produce paper, that it's just going exponential, what's going to be your normal response there? You're going to be finding a way to buy gold because you know that at some point in the future, this monetary system is going to revert back. That's
Absolutely.
my theory. My theory, I have no proof for it, nothing, but I'm out there. I'm going to be looking and watching for evidence that other central banks, when you see Kazakhstan and Belarus and countries most people never even heard of, and their central banks are buying gold, I got to believe they're all doing it on the sly, and it's a game here, and eventually the music's going to stop, and you're going to be stuck either sitting down or with no chair.
Absolutely. But what I've been looking at is the fact that in order to accomplish any kind of move back towards a gold standard, you've got to have a real handle on a budget that is somehow balanced to GDP. And there's only one country that's actually close to doing that, and that's China. Mm-hmm. China really, in my opinion, is the only country that has the ability to go on the gold standard. For the United States to re-implement either a bimetal standard or a gold standard, we'd have to have a handle on this, $15 trillion deficit that we have. Now, the good news is that does equate to about an annual GDP of the United States, but we're certainly not paying it off. And to re-enter a gold standard, you've got to really balance your books. And what countries out there have that ability?
Yeah, well, I think there's going to be a huge write-down and a jubilee for central banks and for countries because the debt unsustainable. It all has to be written down, and I think that's the final chapter. We're a ways from it, but that's where we're heading. I don't see anything out there that's ever going to stop it, because it can only, these systems, fractional reserve systems, and really we have like no fractional reserve any longer. They can only go on as long as there's confidence in it, and the world daily is losing confidence in the entire scheme.
Absolutely. The one thing that I'm looking at right now is that we had factored into the price of gold the uncertainty going on in the European Union, the debt crisis, what was going on with Greece. Now, they so eloquently provided a bailout package for Greece, which is great. And it kind of took that premium out of gold, because the belief was we had a much more stable European Union in terms of their economy and their finances. One thing you've got to say is that unlike the United States of America, the European Union for the first time had to work with multiple central banks to find a solution for one particular country. Now, that being said, what's re-entered the news now is Spain is having some issues. Portugal also does, and Italy does. Now, these are economies that are they dwarf the economy in Greece. So is there going to be the ability to continue to bail out these countries that have unsustainable budgetary entitlement programs and continue to kind of put fingers in the dike, so to speak?
Yeah, it looks like they're running out of rope here, because Italy's debt, huge amount of it has to be rolled over in the next 3 to 6 months. And the only way to do that is money printing. So at some point, this thing is going to unravel, and probably later rather than sooner, because they've been able to put it off for so long now. And that's the thing. It's putting it off just makes the final solution worse and worse. And it just really, really does so much more damage. But anyways, is the silver chart going to be showing us similar kind of patterns here, Gary?
Yeah, well, let's take a look at what I've got in terms of silver. Here's an S&P while I'm pulling that up. Let's just go ahead and change that. Well, give me 1 second. We'll get a silver chart up here. This is, first of all, we'll take a look at the longer term chart. Now, this is where you really can see how Henkin Ashi, this average chart, gives you clarity within the market. Now, the one thing is it's going to be a lagging indicator, especially a weekly. So you can see that silver on a weekly basis is in downtrend. When we move that into a daily chart, you get an idea of what we'll call the Russian doll next level. And you can see that we went into this buy mode, as you can see here. Let me go ahead and circle that, but you can really see where we went into this back to green, but it turned right around. And again, this is a daily chart, so this is today's activity. We'll have to see exactly how it ferrets out. But you can see on a daily chart that we went into a buy, but that's kind of been negated. But it has the same wave count as gold right now.
Yeah, it looks kind of similar.
Well, if you put them up side by side, if we put them side by side, then you can really see, as this market goes down, you can see that really the end of the correction that we had last year, the beginning of what I call our first rally of 2012 begins here and here. You can see as this market moves up for about the same amount and then comes down. And so, yeah, you get a very, very similar activity, and the wave count is pretty much identical in terms of the wave count of gold and the wave count of silver right now. You have silver up on the top and gold on the bottom.
Right. Yeah, I see that. They're really close.
Yep. Now, this also is in candlestick format, and you're going to see when I change that to the average format. There we go. Now you can really see a very, very strong similarity. They almost look like mirror images of each other.
Which means that when one goes up or down, it takes the other.
Yes, I tend to look at silver as the little brother of gold, and it tends to tag along. The interesting thing is that even though it's the little brother, it has typically outperformed in terms of percentage basis the gains that we saw in gold, especially last year. It outperformed gold. But the devil's advocate or the caveat is that when the market's coming down, or when you're on the wrong side of the market, let's say, the losses tend to mount up much quicker too. You get these huge percentage moves, and so they're going to help or hurt you whether you're right or wrong in the marketplace.
Yeah, so you really have to look to buying silver more so than gold on the dips, because the volatility, if you can't just buy the metal and put it away and forget about it, it's going to give you ulcers.
Absolutely.
Nosebleeds.
Absolutely. When you consider the kinds of moves that we have seen, for example, when silver dropped, it was a dynamic drop, and this is the $44, so it's our secondary top. The market moves from 44 down to about 26, so almost a 50% move, and it did it in under a 2-month period of time.
Yeah.
A very, very strong move.
Not for weak holders.
No, it isn't. But the key to me is to have a grip or a firm understanding of what you're trying to accomplish. So in this case, what I noticed in silver was we talked about how gold had retraced 61%. Well, silver was a little bit different. Silver actually retraced, and I'm going to put this up for us. Yep, let me just tighten that one color here. Mm-hmm. What you're going to notice is rather than a 61% retracement, this is a 50% retracement that we're looking at. Right. So, in other words, it moved from $0 to $1 and then came back to 50 cents. Is the easiest way to look at these Fibonacci retracement levels. The beauty of it is it gives us the ability to have predetermined pivot points in which we look at how the market reacts here. It doesn't mean we're going to be right, but what it does mean is these are points that we'll look at. In other words, when the market's coming down at 38, 50, and 61, those are going to be the points that we look at to see some sort of reversal. So what I use is a technique in which I combine 3 different indicators: Japanese candlesticks, Elliott wave, and Fibonacci. So I'm expecting the market to come to a certain level. Then I look for either a Henkin chart reversal or a candlestick reversal and look for a pattern that tells me we've got a key pivot point happening in the market. If I get 2 of these things lining up together, it gives me a higher probability of success and some reasonable belief that I have a strong potential trade in the works.
Yeah, I can see it. It looks like it's getting ready, huh?
Absolutely. After this market retraced, and that's what we've all experienced, was the end of February through March, we hit our bottom. And so now, even with the market on a day like today where it's down 20, I am still very, very bullish because what I see is a expected retracement. Now, it came sooner than I thought it would, but right now is the time to begin accumulating again. This is a perfect opportunity. Physical buyers, go ahead and buy the silver rounds or your maple leafs. I'm a commodity trader, so this is where we enter positions. Now, we have positions currently that are in slight profit, so there's no point in adding. I've already added once.
Gotcha. All right. Well, hey, this has really been enlightening, and it's so much more real when you're actually looking at the charts and following the logic. So if you want to find out more about what you're doing, Gary, and learn more about your technical trading systems, where do you go?
TheGoldForecast.com, one word.
TheGoldForecast.com. I think we have a link to it on the site in the resource tab. And Gary, we're going to have a roundtable with you and a couple other people in a couple of weeks. I'll shoot out the notices, and you'll be able to go to KerryLutz.com, see the upcoming one, and we'll see you then.
Perfect. As always, Kerry, a pleasure speaking with you, and I wish you and your viewers the best of the rest of the day.
Hey, you too. Thanks, Gary.
My pleasure. Bye-bye.